It's time now for our business update, and Brian Quinn is in studio. Brian, starting with a hefty fine for Deutsche Bank over a rate-fixing scandal.
That's right. Deutsche has agreed to pay $220 million to settle a U.S. inquiry into manipulation of the LIBOR interest rate. The LIBOR stands for the London Interbank Offered Rate. It's a benchmark based on what banks charge each other to borrow. It's used to set interest rates for hundreds of trillions of dollars worth of financial products like mortgages and credit cards. Attorneys for New York and California found that Deutsche made false submissions on its own interbank rates and influenced other banks' rates, manipulating LIBOR to benefit its own financial positions. The most recent penalty comes on top of a $2.5 billion fine slapped on Deutsche by U.S. and U.K. officials in 2015. Deutsche says this $220 million settles the last of its LIBOR investigations in the U.S. The news comes as Deutsche has posted third-quarter profits that more than doubled analyst estimates. It's time now for a check on the markets. Asian indexes mixed in Thursday trading following a dip on Wall Street. Investors looking ahead to a meeting of the European Central Bank coming later today, where ECB President Mario Draghi is expected to announce a gradual end to its bond buying program. Tokyo's Nikkei index up just over 0.1%. The Shanghai Composite up around 0.3. Hong Kong's Hang Seng index off by around 0.4%, with South Korea's Kospi not too far behind it. Well, for more on that meeting of the European Central Bank later today, we're joined here in the studio by Naeem Aslam, Chief Markets Analyst for Think Markets. Naeem, it's being billed as the ECB's most important meeting of the year, where we will finally find out by how much and for how long the bank will be winding down the asset purchase program. It's the famous tapering of quantitative easing. What do you think we're going to see today?
Thanks for having me. I think, as you said, the market's been waiting for this moment in a very long time. Now, I think when we look at this event today, we have two different scenarios. Are we going to see this tapering process? How long the tapering process is going to be? Going to be 40 billion or is it going to be 30 billion worth of tapering, right? So we have two numbers sitting right out there and looking to us. But then the other part is the period. Is it going to be 6 months and 9 months? But why that is so important? Is it because 6 months or 9 months doesn't make that much of a difference? Yes, it does make a difference. The reason it does make a difference, because soon the ECB is done with the tapering. What's the next biggest thing? It's your interest rate hike.
Exactly.
So the shorter the period, that, for instance, if the ECB says that, okay, it's going to be 40 billion and it's going to be 6 month period, then that means the market would anchor those expectations with respect to interest rate. Because the next question is that, okay, now the interest rate is going to start going up. And that would move the euro strength, like against a number of different currencies. And remember, Mario Draghi, the president of the European Central Bank, he has his concerns about the strength of that currency. I mean, we touched nearly 121 and went back all the way to 117, and now trading in around 118. So I think going into this meeting, investors will be parsing the tone and the language of this meeting very, very carefully, because I think it's quite important to emphasize the Governing Council of the European Central Bank made of more doves than hawks. Anything, even partially, slightly more hawkish, would be perceived by a market a very, very hawkish message, because a number of other members, they are all doves. So I think that has a potential to bring a massive move in the currency, regardless whether the period is 6 months or a 9 month.
Well, Mario Draghi sounds like he's trying to keep his options open on the one hand, but as you say, there's hawks on the other side. There's especially from the German contingent, who want this program wound down as quickly as possible. They say that the EU economy is healthy now, essentially that the quantitative easing program has outlived its usefulness. It's done its job. It's time to be done with it. What do you think? Is the EU economy strong enough to be done with it?
The QE program was introduced to stoke inflation and stimulate growth, lower unemployment, improve the liquidity in the market, improve the credit conditions in the most weakest economy in the Eurozone. And if we look at all these numbers today, what they tell us one thing, that yes, these economies, these numbers, they have improved substantially. So yes, I do concur with that German stance that there is absolutely no need for this ECB to pump that amount of a quantitative easing in the market. I think now is the time for the ECB to start locking those doors for the quantitative easing and perhaps scaling down that process.
Interesting. Well, obviously a lot of those economic indicators are greatly improved, but inflation is the one that's been stubbornly weak in the EU. Do you think there's anything that Draghi can do about that, or the ECB?
I think it's with respect to improvement in the labor market, lower unemployment rate, and I think that would pretty much support that inflation. But inflation is one of the sticky point which ECB hasn't been able to achieve, and I think it's going to still take some time for ECB to achieve that. And I think in going into this meeting, the president of the European Central Bank would use that as an excuse to reassure, to reiterate the market that, look, yes, even though we are starting the process of tapering, scaling down this quantitative easing, but remember, we can always change our path depending on the economic data.
So that's Draghi's hedge, is the inflation, that if he wants to bring it back, he maybe can bring it back. Well, we're obviously seeing also a fair bit of political tension in the union, especially around Catalonia's bid for independence. What do you think the prospects are for the EU's recovery being derailed by these kind of disputes between states? It's not the only one that's going on right now.
Yeah, I'm glad that you brought that. I think that's a very important point, because these political tensions and escalation in this area could certainly derail all that recovery, and the labor for the hard work, it just can be completely undone by this. Because remember, we also have Italian elections coming up going into 2018, and Five Star Movement, that party, is getting stronger and stronger. So if we have Catalonian completely leaving Spain, and then Five Star Movement, I think the situation would become a lot more dire.
Well, thanks very much. That's Naeem Aslam of Think Markets with us here on set, and that's it for business for me.
Okay, and indeed for this edition, we're going to have to take a very quick break now. Back with all the latest updates in just a few minutes.